This week on Wealthtrack, a surprising stock strategy for the future that relies on the past, from the best-selling author, Wharton wizard Jeremy Siegel. Year-end tax strategies from the Wall Street Journal's Tom Herman, and can jewelry dazzle as an investment? We'll hear from a noted gemologist. It's all ahead on Consuelo Mack Wealthtrack.
For investors who think long-term, strategy is only half the game. It takes creative moves. Merrill Lynch Investment Managers, innovative solutions for investors.
Hello and welcome to Wealthtrack. I'm Consuelo Mack. If you're a stock investor, there were some positive inflection points in major market indices this week. At one point, the Dow hit an 8-month high, while the S&P 500 and the NASDAQ each reached 4-year peaks. Some healthy earnings reports from retailers and falling energy prices, which brought some key inflation numbers down, all contributed to the upswings. But perhaps no two stocks better exemplify the mood swings of investors than General Motors and Google. Worries about financial frailty and even bankruptcy have driven shares of General Motors stock to its lowest level since 1987. GM was down 20% in the last week before regaining some lost ground after its chairman and CEO reassured employees that bankruptcy is not an option. Meanwhile, Google stock crossed over the $400 a share mark, the only NASDAQ stock in that rarefied atmosphere. There are 6 on the New York Stock Exchange. Shares of the world's dominant internet search engine have quadrupled since the company went public in August of last year. The total stock market value, the so-called market capitalization of the 7-year-old company, is now more than $112 billion, larger than global consumer giant and Centurion Coca-Cola. Analysts have been increasing their price targets for Google stock following its strong profit report of last month. What are the long-term prospects for investors in new economy versus old economy stocks? Some surprising answers from Wharton finance professor Jeremy Siegel are next. The best long-term investment returns from stocks, plus taxes and jewelry, are our focus on Wealthtrack today. Joining us are 3 experts in those separate fields. First up, legendary finance professor Jeremy Siegel, who is known as the Wizard of Wharton, as in the Wharton School of the University of Pennsylvania, where he is famous for his original research, terrific teaching, and investment classic Stocks for the Long Run, which the Washington Post has deemed one of the 10 best investment books of all time. Now, his new book, The Future for Investors: Why the Tried and True Triumph Over the Bold and New, will give it a run for its money and challenge some of your most cherished methods of stock picking. Well, when it comes to the complexity of taxes, no one can explain it better than Wall Street Journal tax columnist Tom Herman, who is here to tell us what we should do before year end. And considering the Wealthtrack mission of helping you with all of the investments you care about, we decided what better time than now to learn more about jewelry. So we asked Patrizia Ferenzi, former head of Christie's jewelry department, now a private dealer and gemologist, to advise us. Welcome to all of you. It's great to have you here. Jeremy, I want to start with you because I had a chance to read your new book, and it really is terrific. But it also does challenge a lot of what I have always been taught to believe is how I should pick stocks. So, you know, the future for investors, and you came up with some startling conclusions that the tried and true outperform the bold and the new. Describe the tried and true.
Well, the tried and true are a lot of stocks that have been around for a long time. Procter & Gamble, Colgate-Palmolive, Pepsi, Coke, brand names we've all known. They are not the technology stocks. They're not those that break into new areas.
They're not Google.
They are not Google.
Right.
Although those stockholders are certainly happy in the last few weeks. But those are the ones that decade after decade have provided investors with superior returns, better than the S&P 500 index, which is a very tough index for many money managers to beat.
So let's look at some of the statistics, the research that you did, and we are talking long term. So we have a graphic that's in your new book, and basically it shows annual growth rates of two stocks, compares IBM versus Standard Oil of New Jersey. And tell us, what this shows us.
Well, what this shows us is that over the last, let's say, 50 years,
right.
IBM has outclassed Standard Oil of New Jersey, which became ExxonMobil,
right.
In earnings growth, in dividend growth, in sales, virtually every...
Earnings per share.
Earnings per share, the favorite metric that Wall Street uses to judge stocks. And if you were shown those, you'd say, yeah, I want to be in IBM.
Exactly, and I don't want to be in Standard Oil. However, so we go to your next graphic, which I'm sure surprised you as much as it surprised us, is when we add up the price appreciation IBM won,
right.
And by a long shot over Standard Oil, which, as you said, became ExxonMobil. Dividend returns, and then what happened? Where's the difference that actually gave us the greater total return in Standard Oil than it did
IBM?
It was
a huge difference in dividend.
Yeah.
Average dividend yield over 5% in Standard Oil New Jersey, less than 2% IBM. And that 3% a year made the difference. So a long-term investor who reinvested their dividends, which is the way we measure returns,
right.
did better in that old economy stock, Standard Oil of New Jersey, than they did in one of the fastest growing companies in the world, IBM.
Now, 50 years is a long time, and most of us don't invest for 50 years. I wish that we were so lucky, but a lot of us are not. So if we're talking about a 10 or 20 or 30-year time horizon, do the same metrics hold true?
Yes.
They do.
You certainly, over a longer period of time, these things are more likely to hold true. But I found decade after decade, these companies often outperformed. Those with high dividend yields, those that have reasonable prices relative to what their earnings were, they didn't get the excitement and the press, but they kept on churning out profits, and that was critical for long-term investment. Remember, 20 and 30 years in retirement portfolios, that's where you want to be. These are the type of stocks you want to put away when you're young, tell them to reinvest those dividends, or the mutual funds that buy them reinvest those dividends. And it shows you're going to be ahead in the long run.
So what's the key difference? You mentioned dividends, but there's something else. Number one, we should reinvest our dividends in the stock,
yes,
so that we keep building our stock position.
Right.
But looking at the high PEs, there's a difference too, right? The
yes.
value of what you can buy.
The top performing stocks over the last 50 years, they were very fast growers in terms of the earnings, but you paid a reasonable price for them. You've heard of GARP stocks, GARP, right. Growth at a reasonable price. Those were the type of stocks that grew much faster, but you only paid 2 or 3 PE points above the average, and they paid a good dividend. That's the type of stocks. Those were the survivors that did very, very well. Those are the ones that really outclassed the averages and even the active money managers.
Okay, so best strategy for building long-term wealth is what then?
Well, I like dividend yields. That became very important. I did a number of studies I show in my book about how that can add up to 3% per year. I like 3 sectors, 2 of which are battered down now, pharmaceuticals and consumer staples. Consuelo, out of the 20 best performing stocks in the S&P 500 since the year it was founded, which is 1957, 18 of the 20 come from those 2 sectors. The consumer staples, right. Brand name, international stocks, and the pharmaceuticals. I like both of those. And then a sector, I wrote about it in 2003 before the oil came up. Energy shrank from 25% of the market to 8%, but did better than the average. Good returns, good dividend yields, outperformed technology, outperformed financials, both of which expanded dramatically.
And you expect that to continue?
I would say I can't guarantee it every
right.
year, every 5 or 10 years.
But over the long term?
Over the long run, that seemed to persist over nearly half a century.
Tom Herman, the tax consequences, if we were lucky enough to follow Professor Siegel's advice at any rate and make money, or if we were unlucky enough not to and lose money, What are the tax consequences this year? What should we be doing?
Well, this is a great time of year to take a look at all your investments and focus on the losers. Focus on the investments you bought years ago that are underwater and you were thinking of getting rid of them anyway. If you were going to dump them anyway, this is a very good time to do it.
Why?
Well, these losses may be painful, but they can be very helpful in cutting your taxes. They can do it in two ways. First, you can offset your gains and your losses evenly. So if you had a $20,000 gain earlier this year and a $20,000 loss now, you put them together, no tax. Then here's the part a lot of people don't know about. Let's say your losses exceed your gains, and I know a lot of people in that camp. In that case, you can take as much as $3,000 of your losses in most cases and offset it against your ordinary income, your wages, your dividends, interest, and that's a very valuable point. It's half that if you're married filing separately, but for most people, that's a $3,000 offset against ordinary income. This is the time to take a fresh look at your investments. That can be a very good tax tip right around now.
All right. Mutual fund holdings. A lot of people at the end of the year, actually we advocated on Wealthtrack, is that kind of to rebalance their portfolios. But if you're in mutual funds, that can be a problem. So what do we need to know about our mutual fund tax treatment?
You have to be really careful before you jump into a mutual fund, especially a stock mutual fund around this time of year. This is the time of year when mutual funds pay out their capital gains for the year. Now, that may sound like something you want, but actually it's not, because you're getting back your own money and you're getting hit with a tax bill. So before you make a big investment in a mutual fund, call the fund, or even better, check its website. See if it's going to make a payout, and if so, how much. And if that's going to mean a tax hit for you, consider buying another mutual fund for the time being, or just wait until after the fund pays that money out, and then you can save a big tax hit.
Now, you and I have done a lot of these year-end tax planning. And one of the things that we've always talked about is the general advice to most of us at year-end, if we can do it, is to reduce our tax burden now, is to basically to accelerate deductions this year and defer income to next year. That works for most of us, right?
Yes, it works for the large majority of taxpayers, but not for all. But an example would be if you were going to make charitable contributions, do them now instead of next year. But it doesn't work for a lot of people who are on what's called the alternative minimum tax, or AMT.
Right.
And that's about 4 million people this year. If Congress doesn't change it, it'll be 21 million people next year. For those people sometimes need to consider the opposite strategy. For instance, if you're considering prepaying state and local taxes that aren't due until January, if you know you're going to be on the AMT next year but not this year, you'd want to prepay them this year.
Okay. I'm going to have to turn to Patrizia Ferenzi, because I'm looking at these gorgeous diamond brooches that you have on, and they do say that diamonds are a girl's best friend. So I want to know, are diamonds an investor's best friend? Is jewelry a good investment in your experience?
I would say jewelry is beautiful, and that's where we have to start from. And it's there to adorn someone and to get pleasure out of it for the people who look and for the people who wear. And that would be really my first answer. Obviously, over time and over years, jewelry has increased in value, but not, I would say, you have to buy jewelry for love and for something else, emotion, affection, beauty, but not really to say, oh, this is a great investment.
So what makes a piece of jewelry, though, special that would cause it to hold its value more than another piece of jewelry? What is it that we should look for?
First of all, we have to go, I would say we would have to talk about trends.
Right.
Trends come and go. And something that's maybe in trend today may not be in trend tomorrow. And something that was in trend yesterday is not today. So do you buy during the trend, or do you buy off the trend? If you can buy off the trend and sell in the trend, or sort of foresee the trend, then obviously you can be a winner. There is people, by example, now who are definitely buying 70s jewelry that may look to all of you think, dated, I don't like it. And I'm sure 10 years from now we'll say, oh, we want it. And from what I'm wearing, this is something from the 1800s. And it has come and gone into fashion and come back and gone back. And
it's in now, right?
It's totally in. But if I showed this to my grandmother,
right,
she would say, this looks old. You know what I'm saying? I don't have a grandmother anymore, but
right,
she would have said it looks old because it reminded her of her mother. Now it's very much in fashion. It's beautiful. You cannot reproduce it today, so it's one of a kind, and it is what it is. And therefore, there is also a part of it which is history, and which is something that was and not is anymore.
Right. So I guess if you wanted to sell a piece of jewelry, you can never tell whether or not jewelry is going to be in or out, so that you can't depend on
That's
a piece
right.
of jewelry to give you the return that you might have even paid for it.
That's right.
At any given time.
You may get what you paid, you may get much more, and you also may get less. And there is not there is not one set
Right.
thing that I can say about that. I would say in certain things, yes, you know, this is in fashion. This has been in fashion for 30 years. It's Tiffany's, Schlumberger. Some were made in France. Some are made in this country. They still make them.
The Schlumberger, is that what it is?
Yeah. And they still
It's
make
gorgeous.
them. It's beautiful.
Right.
It comes in every color. Some women collect it, and it's still in fashion. But, you know, I can show you 20 things that were created at the same time as this that no one wants.
So, Patrizia, if you want to sell jewelry, where is the best place to do it? I mean, you know, do you go to your local jeweler? Do you?
I think you have to go to someone you trust. Trust is a very important part of jewelry when you buy and when you sell. And that's fundamental in my mind. And I know it's a hard thing because I cannot say to you, you can trust this one or you can trust that one. But trust is a very important part of it. You go to your jeweler, you can, I would say, you can sell at auction, and sometimes you can be very successful in doing that, and sometimes not at all, because the spread is very big. There is a 30% basically spread in between buying and selling. Yeah, and you can, I would say, or sell privately to a reputable dealer or someone that you have been recommended to or that you know of.
But there's no guarantee, certainly, that you're going to get what you paid for it, or so it's an illiquid market. But what I wanted to ask Jeremy Siegel about is alternative investments. You know, what part do they play? And I don't know if you would consider jewelry to be an alternative investment, but gold is at an 18-year high right now.
Yes.
So what part do they play in your strategy?
It's interesting because I've looked at gold over 200 years, and it is not a good long-term investment. It stays a little bit ahead of inflation, just a tiny bit, a few pennies. Again, just like Beatrice is saying, you need to love it when you have it.
Right.
You know, they often say that about homes, but a lot of people think they turn into investments. You got to love what you're living in at the same time. But I think it's particularly true with jewelry, is that you have to love it. And again, crafted the way I see that fine is, you know, when you just talk about gold as bullion, it's one thing. But gold coins, the numismatic values of them have gone way up. Fine jewelry where the craftsmanship is so extremely good, so what you see, that would tend to rise.
That's exactly what I was going to say to you. Gold is just gold. It's a metal, it's available. The craftsmanship of certain pieces, and this is certainly one of them, cannot be really reproduced today. And that's something that creates then some value that's added.
Right.
You know, and we can go into many pieces that were made in the 20s, were sold maybe 20 years ago, 25 years when I started working, and that if I was to put them on the market today would be a great investment. So there is this example, but I don't want to mislead anyone because there is not a rule.
Right. You know, Tom, the tax treatment of jewelry, for instance, if I were to value one of Patrizia's, you know, the brooches at a fairly high value, I mean, is there a point where the IRS looks at you askance and would, you know, question a valuation that you've made on a piece of property, jewelry?
Yes, absolutely. You've got to get very good appraisals. And the other point is that the tax rate on capital gains, if you're lucky enough to make a gain, is higher on collectibles and art in general. It's 28%, not 15%, which is the top capital gains rate on stocks and bonds. So that's another thing to think of, but it's a nice problem to have if you can have it.
Oh, absolutely.
But I was curious, Patricia, what's the best place to buy? Is it better to buy at auctions, or is it better to go to a reputable dealer, or where do you get the best bargains?
I would say, again, it's a matter of trust. And you can buy at auction and you can buy very well, but you can also buy at auction, and when you don't know what you're doing, you're lost, and you don't know.
Right.
And
because,
it's
I mean, you were at Christie's,
That's right.
and now you're independent.
And then
so
I'm independent, and I do buy it. I do buy at auction also. So I'm not saying auction is not. It's a good source if you know what you're doing. So I would say if you buy at auction, you really have to get very good advice from someone you trust. Trust at the end is a very big key in this business, and that's one of the answers.
I am going to go now to the one investment that for all of us to make for a long-term portfolio. So, Professor Jeremy Siegel, what would the one long-term investment you think everyone should have in their portfolio?
Well, in my book, Future for Investors, I talk about the growth in the world economy, and that most of the growth is going to be outside the United States, outside of Europe, and outside of Japan.
And as a matter of fact, you are advocating up to 40% of an individual's portfolio should be in international
Up to
stocks.
40%.
Right.
That's the highest of almost anyone.
Anyone, absolutely.
And because actually today, over half of the world's equity capital is outside the United States. And I think it's so important to participate in that. So my one investment is an index fund linked to the world capital market, EAFE, E-A-F-E,
right.
Europe, Australia, and the Far East. And you can buy it as an ETF, exchange-traded fund.
Right, an iShare.
Yes, an iShare. And it's done very, very well. It'll give you broad international diversification. Don't give up on the United States, of course.
Right.
That's still important. But that's the if you want to know, the easiest way to get that international exposure, the EAFE index is the way.
That's one. Tom Herman, what is your one investment from a tax perspective?
I'd suggest that people take the maximum advantage they can of their 401k plans. And I find a lot of my friends don't realize that the amounts have gone up. For instance, if you're under 50 this year, you can put away as much as $14,000. If you're 50 or older at any time during this year, another $4,000. So that's a total of $18,000, and it's going up again next year. It's a great way to save. It's a great tax-advantaged way to save.
So you would max out your 401k.
Yes.
Just to invest as much as you can for long-term investment returns. Patrizia Ferenzi, all right, the one investment from a gemologist point of view.
I would say buy something you love, buy something secondhand, and
a signed piece. But why secondhand? That's really interesting.
Because when you buy something secondhand, some of the cost of making the piece has already been dissipated. So you are really buying a little more intrinsic value versus the labor of today. You are paying the labor of 20, 30, 50, 100, 200 years ago.
Right.
So it evens out better.
All right. So it's like almost like buying a car. If you buy it secondhand, you're going to pay a lot less for it.
That's right. That's right.
But hopefully it will hold its value much better than that.
Exactly. The car will still go down. The jewelry hopefully will go up.
Right, will go up. Exactly.
Really, exactly.
Well, thank you all. Professor Jeremy Siegel, just a treat to have you.
Thank you for having me.
Really is. Tom Herman, always great to have you here. And Patrizia Ferenzi, it's terrific to have you as well.
Thank you
Thanks.
so much.
Glad to talk about jewelry. Something very different and very interesting to our viewers. Now, at the conclusion of every Wealth Track, we leave you with one action you might want to take to build your wealth. So this week's advice involves cash. Cash may be king, but it hasn't been treated like royalty lately because interest rates have been so low. But as you all know, things have changed rapidly. 12 interest rate hikes by the Federal Reserve over the past 17 months have sent short-term interest rates up a full 3 percentage points. With cash now a much better deal, our action point this week is maximize your cash returns. And there are several ways to do that. Banks offer savings accounts and money market accounts, and rates at banks can vary a lot, so it pays to definitely shop around. 2 online banks offer very competitive rates to savers. The ING Orange Savings Account currently offers a 3.5% annual yield, and Emigrant Direct's American Dream Savings Account is paying 4%. Both are federally insured and don't require minimum investments. Now, if you want to lock in an interest rate, you should consider bank certificates of deposit. Many experts advise keeping the duration on CDs relatively brief right now, not more than 6 months, because they expect the Fed to continue to raise short-term interest rates for several months at least. The pros advice, don't accept less than 4% for a 6-month CD. Another option for your cash is a money market account. They are not government insured, but ones run by reputable firms are almost as safe as money in the bank. The average money market fund now yields 3.38%. And some of the best yields are being offered by the Vanguard Prime Money Market Fund, which requires a $3,000 minimum and returns 3.74%, and Fidelity Cash Reserves at 3.67% with a minimum of $2,500. For more information, check our website, wealthtrack.com, for links to our recommended sites. Cash returns being offered now are definitely worth the hunt. And that wraps up this edition of Wealthtrack. We hope you can join us next week when we hear from two very different people, very different views about building and protecting wealth over the long term. Morgan Stanley strategist David Darst, who wrote The Art of Asset Allocation, explains the virtues of diversifying your portfolio among a broad range of investments. But in contrast, successful money manager Robert Kessler explains the virtues of his firm's focus on one investment class, and that is Treasury bonds. Which strategy is right for you? We'll find out from them. For more information about Wealthtrack and our guests and their recommendations, log on to our website at wealthtrack.com. We look forward to hearing from you. In the meantime, have a happy Thanksgiving and make the week ahead a profitable and a productive one.
For investors who think long-term, strategy is only half the game. It takes creative moves. Merrill Lynch Investment Managers, innovative solutions for investors.